Welcome to the Wealthy Life Podcast. I'm Sybil Verch, and today we're going to talk about the role of a financial advisor. What is a financial advisor? What do they do? Do you even need one? What do they cost? We're going to find out. And joining us today is wealth advisor Jill Cramp from Generational Wealth Management at Raymond James Ltd. Jill, welcome to the show.
Thanks, Sybil. I'm excited to dive into it. There's lots to go through, and we wear a lot of hats that a lot of people don't even know about.
I know, and it's funny because when I talk to people and ask them if they have a financial advisor, and those that say no, they don't even know what an advisor is and what they can do. So we're going to get into that. Before we talk about the role of an advisor, I'd like to ask my guests a question. I'm going to ask that of you. What does living the wealthy life mean to you?
Well, I imagine you get lots of different answers to this question because it's a very personal question. So when I think about what a wealthy life means to me, I think that the word that comes to mind is comfort, right? Comfort knowing that you have, for your finances in order, you have enough to buy groceries, you have a plan for your kids when they get older, maybe transferring some of your assets to them when they get older. But a big part, not only about the money side of things, is to be wealthy is also to have good health, right?
Yes.
That's a big piece of it as well. So, those two things work together too, because when you're healthy, you live longer, you might need more money, you might want to do more traveling, all that sort of stuff. So it blends together into kind of a holistic way of looking at wealth to me.
That's good. Thank you. So what is the role of a financial advisor? And what is a financial advisor?
Well, I say at a core level, a financial advisor is someone who helps you, with your finances, make investment decisions, come up with a plan for how to save your money and how to spend your money. But there's more to it than that. There's, the estate planning side of things. There's the insurance side of things. There's whether you want to be charitable and give money at the end of the day. Yeah. Those are all parts of our overall job.
Yeah, so it's kind of like being the money coach. Yeah. It's like helping people set the goals that they want to achieve and make better decisions when it comes to their finances and their money. There's a lot of different titles out there. There's financial advisor, there's investment advisor, portfolio manager, wealth advisor. Yeah. What are the differences between some of those? Yeah,
and not only titles, but acronyms. Yes. Our industry has so many acronyms that people don't understand, right? Yeah. So there's like a certified financial analyst would be somebody who helps, dive into the details of companies, on both the advisor side, but also on the research side. There's
the stock picking side.
The stock picking side,
yes.
And then there's a certified financial planner who can be an advisor as well. So they help you with doing more comprehensive financial plans on top of being your regular advisor for your stocks and your wealth plan in general. You've got a portfolio manager who can pick stocks for you on a discretionary basis, meaning that they run their own portfolio of stocks. So there's so many different sides of this that you can work with one or another or both or all together sort of thing.
Yeah, and I know that the titles get a little bit confusing for people because investment advisor, people just assume that's someone who's just going to help you pick your investments. Mm-hmm. But it doesn't necessarily mean that because they can help you, as you say, with more of the planning element of things. And then financial advisor is such a generic title that there's financial advisors that work in bank branches, all the way up to financial advisors that work for full-service advisory firms. So what are some of the specific things those financial advisors do for people, and is there a difference? We have some firms have different regulatory bodies too. So some advisors that are at the bank can only deal with mutual funds, for instance. Okay. Sometimes they can only deal with their own bank's products as well. Mm-hmm. More of the full-scale financial advisor can buy products from various banks, but not one particular bank. But they can also buy stocks, ETFs, run portfolios of their own stock picking portfolio. They're kind of the more holistic side of things, in my opinion, because usually it comes along with things like tax planning and estate planning and charitable giving, kind of the more full wealth picture. Right.
So there is a difference, and there's a place for both of them.
Yes. So let's talk about that a little bit. And what should people expect
Like what is important to people? What should they be asking for?
Yeah, well, I mean, I think that when you're for an example, say you're starting out, you have a fairly simple income sort of stream. You maybe don't have dependents that you're worried about, more simplistic sort of needs. You know, do you need the full service advisor? Probably not, right? You probably can go to the bank, pick some, you know, ETFs or not ETFs, or mutual funds that would fit your risk tolerance profile. And an advisor, you know, you might get a different advisor every time you go into the bank. You might not get the same team that's there to help you all the time, but you know, maybe that's all you need in that moment.
Right.
But then sometimes you outgrow that as well, and you do need more of the planning. You know, if you're wanting to transfer assets to a child with disabilities, like you have to start thinking of that stuff well in advance. Do you need to look at your tax situation because, you know, you have more of a tax burden than others? Like where is it going to make the most sense to put your money in that situation? So, you know, that's just beyond investment picking. That's a more bigger picture planning.
Yeah. So the full service advisor, it sounds like, wears many different hats and can provide many different services.
Yeah.
To an advisor or to a client. So what are some of the different hats?
Lots. So definitely financial planning would be a big one, right? Coming up with that roadmap that you need to get you through various stages of your life.
Isn't that where everything should start?
Yeah, that's a good starting spot, for sure. Like if we had all done that when we were 18, you know, and came up with a plan, you know, everybody would probably be in a different situation now than not doing it,
well,
right?
What would an 18-year-old even think about
when
it comes to planning?
Too, right? Well, no, I think that's kind of the problem sometimes, is that you're not taught this stuff in school. You're not taught this stuff in high school.
No.
So, you know, to even know that there's different accounts out there and what they mean, and the difference between a first home savers account and a tax-free savings account and a non-registered account, and, you know, is a tax-free savings account just for savings?
Yes.
You know, or can I buy, you know, an ETF in there? That sort of thing. So
well, let's talk about the 18-year-old, because I think this would be a good example to highlight the different stages and the different services you may need. So I'm thinking back to when I was 18. Maybe I don't want to think back to when I'm 18. But even my son, when he was 18 years old, what are some of the goals that he had? Well, he's not really thinking about retirement yet at 18, but should be. And I think would be if an advisor had that conversation. Yeah. I do remember when I was quite young, I think it was maybe about 18 or 19 at university, and I remember a finance professor showed me the power of compounding growth.
Yes, yeah.
And used an example of, if I just put $2,000 a year in investments and let it grow, how much money I would have later in life. That was enough to get me interested and to start saving right away. Yeah. So I guess we shouldn't assume that kids don't want to think about retirement. They don't. But we can change that.
Yeah, absolutely. And I do think it's an exciting time for kids growing up now, because I think there is more interest in investing, because there are platforms where, you know, some kids can go and you know, dabble a little if they want.
Yes.
You know, and I do think also too, it's changing for how much women are involved in that sort of thing too, versus back in the day. So I do think that there's you know, and it's in the news a lot more, and, you know, access is available everywhere to do even your own little bit of, you know, investigating in what type of investments you'd like to be in. So yeah, I think that's interesting. But I think that what is kind of the missing part is not so much picking your investments, it's knowing which buckets to put them in, right? So an 18-year-old kid who doesn't have a very big income, you know, he's not really getting the tax benefits of if he puts it in his RSP account versus later when he's maybe earning $60,000 to $70,000 a year, right?
Right.
So, you know, and then the first home savers account is a new account too, and that's a great place for kids to start out if they want to save for home.
Well, and I think most kids do. I was just teaching a junior achievement class on personal finance at one of the high schools. And I asked the kids in the class, what is it you want to save money for? Yeah. So these are grade 11, so this is even younger. Yeah. And the majority of them, I'd say at least 80%, said they wanted to buy a home one day.
Yeah. Yeah.
And so I thought, okay, great. It doesn't mean that's always the best decision for everyone, but generally it is, and it's a great goal to have.
Yeah.
So starting with a first-time home savers account. So an advisor can help them with that. An advisor can help them what type of account you should save for, what are the goals you want to save for, how much you need to save to put money aside.
Yeah. And come up with a plan. We're back to the plan.
Yeah, come back to the plan. But you mentioned earlier, when you're just starting out, you may not use a full service financial advisor versus going into your bank.
Yeah.
And so why is that? Is it a cost issue?
So when you're first starting out,
Yeah.
you mean? I think, I think it's the needs of that person at that time. You know, when you have a full service advisor, you know, they're there to help you with kind of more complex income needs. Or are you in retirement? Do you have to start pulling out of your accounts at this point to supplement your income? You know, when you're starting out, if you can set yourself up with a monthly savings plan along the way, you know, you probably don't need the full package of a full service advisor.
You don't have a tax problem if you don't have a lot of income. So, you know, paying someone to advise you on tax saving strategies probably isn't going to be worth the money.
That's right. That's right. Yeah. So, I mean, there's the do-it-yourself platform, but there's also the banks. And that's a good starting spot. And then when you realize, oh, I need more help than this, then I think that at that point it might be time to see what else is out there.
So working with a full service advisor, I know there's some barriers to access to full service. And a large part of that tends to be how much money somebody has, or what their needs are, what the fees are, and maybe all those three things come in together. Is there generally a minimum account size that most firms have?
Well, I think it comes down, yes, there typically is. Each advisor can usually set what their amount is, their minimum amount is. You know, some banks don't pay advisors if they have a household that's under a certain level. So an advisor's probably not going to want to take them on if they're not going to make.
What would that level be? What are we talking here?
It varies, but I've heard it's around 300,000 or so. Yeah, 250 to 300. But I mean, every firm is different, right?
So it's a question people need to ask.
They do, for sure. Yeah, definitely. And I think that, you know, I always say in our industry that most of the advisors that I work with, that I know, they're very different than each other. And I think it's because the client needs to connect with that advisor and feel like there's some commonality there, trust, everything like that. So that's a part of it as well, is, you know, when you go in to meet an advisor, you know, to ask, you know, will you even take me on? Do I meet that minimum? But also, too, it's one advisor isn't the same as the other. So meet with more than one when you're looking for an advisor.
So, Jill, what are the questions that an investor should be asking of a financial advisor before choosing a financial advisor? Yeah,
well, there's a few, for sure. So you could start by asking what their credentials are. You know, are they a certified financial planner? Are they a CFA? Are they a portfolio manager? And then with that, what sort of services do they offer you? You know, are you just here to pick investments for me? Or what other things does your firm offer? Does your firm have, you know, a tax department that we can bounce ideas off of? Do you have any sort of charitable giving department? You know, what's your firm's background? You know,
is it a stable firm?
Yeah, absolutely.
Are they going to be here tomorrow in 10 years and 20 years and 50 years from now?
And the other thing too is that, like, when you call, are you going to talk to a person? And is it going to be the same group of people, or are you going to get bounced around?
Oh, that's a good question, because people build a strong relationship when it comes to their money. If they're going to be disclosing everything about them, they want to work with the same person, I'm assuming, for many years to come.
Yeah, absolutely.
They don't want to be bounced around from person to person.
No, and I always say that it's actually an honor to be in this industry, because we have relationships with clients sometimes for decades.
Yes.
And we go through things like the birth of their child, you know, them buying a new home, the death of a spouse. Like, we go through very emotional things with clients, right? So there's this connection, like, we care for them, really, because we ride this wave with them.
And to help guide them through all those stages of life as it pertains to not just their money, but the emotional side as well. Well, let's talk about that a little bit. So this client, hypothetical client you're talking about that has a new baby, what is something a financial advisor would immediately bring up in discussion?
Oh, for sure. RESP accounts right away.
Yeah, yeah.
And you know, you're going to have to start looking at insurance, right?
Okay, so talk about that a little bit. The RESP, what are the benefits of that?
Oh, that's a great account. Yeah. So when you put money into an RESP account, the government will kick in money as well. It's usually about 20%, but if your income is lower, you can receive more than that as well.
Yeah.
And then the account will grow every year. You can put in a certain amount, or you can put in more, but to maximize your grant, you'll put in a certain amount. And then when your child goes to school, post-secondary school, which doesn't only mean universities, there's trade schools that are accepted as well. And you can have that child pull out that money, all the growth and the tax would be the growth and the grants that the government gave you would be taxed to the student, who's typically in a lower tax bracket.
If anything, right?
Right. You can, the clients can, you know, especially if mom and dad are footing the bill to university, it's helpful to get going on that. And you'd have, you know, 18, 20 years or more to grow this money.
So an advisor would advise you on that when these life events occur. You mentioned life insurance at birth of a new baby.
Well, I mean, now you have another human to worry about, right? And if you have two parents working and something happens to one of them, your income could be cut in half or more, right?
Right, so it triggers a review of your insurance needs to make sure that the family would be okay after that. And then talk about some of these other life stages. You mentioned maybe, well, I guess marriage or divorce would be one. And what are things you talk about then?
You would want to go over whether they should be putting all their money into joint name. So that makes sense when you're married, right? Because it will pass on to the spouse if something happened to one of them. You know, you would talk about, I mean, sadly, the passing of a spouse is so traumatic to go through. And if you have set your accounts up, I mean, the last thing you want to deal with when you lose a spouse is dealing with like banking and finances. I mean, you're in the middle of it, right? But if you have set your accounts up so that things flow right, you know, to that surviving spouse easily, it's pretty seamless. It's pretty easy. So to ensure that that's all taken care of well in advance, or to make sure that you have a power of attorney set up. You know, another important piece that you would need if something happened to your spouse and they weren't able to make proper financial decisions down the road.
So what I'm hearing from you is that a really good financial advisor is going to be there for you every step along the way. They're going to be there for you for every major life event. How about if there is no life events and just day to day, how often should you meet with a financial advisor?
Well, I mean, I think the minimum should be once a year, but often, you know, when you have a more complex need, you're meeting more often than that. You know, and especially anytime anything changes. So with your financial situation, you know, meeting with your advisor, and it doesn't, I mean, the one thing out of COVID is that we've all gotten very handy when it comes to virtual meetings as well. So driving into downtown might not be the thing you want to do, but setting up an easy phone call or a Zoom meeting is so simple these days.
What's the role of education for an advisor? Is that their job or not their job?
Oh, I think it's our job. Yeah. I think that you don't want a client leaving your office and not understanding what just happened, right? And education is power, you know, and I think that when a client fully understands why they're doing the things or why the advisor is suggesting the things they're suggesting, it builds confidence in themselves and security and just knowing that, you know, somebody's got your back, but that you also understand. And you don't have to know how to, like, you know, dive through the financials of a corporation, but to have the general idea of why this makes sense.
Right.
You know.
So being comfortable asking those questions. And again, when you're choosing an advisor, asking them how much of an emphasis they put on educating or teaching might be a good question to ask.
Yeah, like back to the acronyms. Like you could sit with an advisor who's spewing acronyms at you, and you might not have any idea what they're talking about, but you have to feel comfortable enough with that person, that advisor, to say, I don't understand what you're saying.
Yeah, time out. What does that mean?
Yeah.
And feel okay with that. How about fees? I mean, people are going to ask what fees are. What are the different ways people can pay for the advice they're getting?
So fees will be dependent on what you're invested in. and what type of account that you have open. So if you are in something called a commission account, which is kind of the original style of account, where
old school,
yeah. When you buy stock, you pay a commission for it, and when you sell stock, you pay the commission to get out of it. That was kind of the go-to way for many, many years. There is now, most people are, involved in a fee-based account, which is you pay a percentage based on what your account value is. So, what I like about this one, and it doesn't suit everybody because sometimes there's a minimum fee every month. So if you have a lower account value, it doesn't make sense. But it puts the advisor and the client on the same side of the table, because when the client is doing really well and their accounts are growing, the advisor is making the same percentage, but their portion goes up as well, like in dollar terms. But when the market's correct and the client loses money, well, the advisor also takes a cut.
Right. So they're feeling the pain too. They're feeling the pains and the gains.
That's right.
At the same time. So it's usually a percentage of the assets they have invested. And subject to a minimum fee. So that's where, if it's a smaller account, the minimum fee
it might not make sense.
Make sense. Is there any other types of fee structures? Like, can they just pay a flat fee, or?
Well, if you say, for instance, for something like a financial plan, that sort of thing, you might go to a financial planner who just charges you a one-time fee to do a financial plan for you, and it's kind of like your relationship at that point could be over, right? It's just the one plan that you get, and you walk away with it. Maybe if you want to update it, maybe they'll pay, charge you another fee to update it. Each one would kind of be dependent on the model of that advisor. But
what's the benefit of that? Like, of just going to a fee-for-service financial planner?
Well, say somebody's doing their own investing. Say they really enjoy doing that, which a lot of people do. But maybe they want to know if they're on the right track.
Right.
That's where that would fit.
That may come into play. What's the downside?
Well, I think if you do a one-and-done financial plan, that's really only a snapshot of where things are at right now. Lots of things can come into play and change the variables that you've used to make that plan. So 10 years down the road, if you grab it and you're like, inflation was 2% here, but now inflation's 4%, maybe things need to be updated along the way. Or maybe you got a big inheritance, that's going to change your situation.
I also think the accountability piece. I think that most people want to work with an advisor that is not only going to hear what their goals are, put a plan in place to achieve those goals, build an investment portfolio that's going to align with those goals, but hold them accountable to it. If they need to save X dollars a month until they retire, do that. If their goal is to pay down their mortgage and their debt before they retire, what does that look like? How do they do that? And make sure they do it.
And I think too, as an advisor, sometimes you have to tell clients stuff they don't want to hear. You're spending too much money. You're going to run out. But that's a tough conversation to have. But better for them to know now, where they can make adjustments, than to the point where they have to sell their house because they don't have any more assets coming in.
Oh, I agree. And so what would a ballpark fee range be? And is it the same for everybody?
Well, there's also mutual funds, which we haven't really talked about, but mutual funds also have fees because there's an investment management firm that's running and picking the stocks within that, they need to get paid as well. So those fees are called MERs, Management Expense Ratio. And the fee on those depends on what type of account you're in. So and the type of investment it is. So if you are in the commission-based, which was the type of account where you pay per buying your stocks and selling your stocks, the MER on that type of account would be higher. So say for an equity, it would be between 2.5% on the MER.
So if you're a growth style investor buying a stock equity mutual fund, about 2.5%.
And that's more of an actively managed mutual fund as well, right? So you can bring it down a little bit if you're just buying index funds. But if you're in the fee-based side of things and you buy a mutual fund in there, the fee on the mutual fund would be lower than in the commission-based one. because there's the advisor's fee is kind of peeled off and charged by itself.
Separately?
Yeah.
Okay.
Yeah.
But then at least you can see the differences.
You
so
can.
the one fee goes to the mutual fund company, the other fee goes to the advisor.
That's right.
Yeah, and I think having, I guess, full transparency on what the fees are, that's a really important question people should be asking before picking an advisor.
For sure.
What are the fees and what are the services I can expect to get for the fees?
Yeah.
Now, is cheapest fees always the best?
No. I mean, you want to look at what your net return is at the end of the day. Isn't that what's most important?
Yeah.
Right?
Your after fee return in your pocket.
Yeah, in your pocket. Yeah.
Yep.
And I can't even count on my hands how many times I've met with people who say, oh, no, I'm just paying this amount. I'm just paying, 1%.
Yes.
And I look at their account and they're invested in a whole bunch of mutual funds. And I know that there's fees in those mutual funds that are on top of that 1%. But it doesn't always get communicated, or maybe in the shuffle of the meetings, it's not, that portion's not specifically laid out. But coming up, there's going to be some changes to the investment world where all of the fees have to come out to clients and be very, very visible about what they're being charged.
And that's going to be an eye-opener for a lot of people. I think especially on the bank channel, and the bank channel is a great option for a lot of people. As you said, when you're just starting out.
Yeah.
One of the downsides of the bank channel might be staff turnover, so you may not have the same relationship with someone long term. You may get lucky and have that, but it's those hidden fees, and I've seen that too, where people, they're not really aware of how much they're paying.
Yeah.
And I think if the average person is paying 2 or 2.5% in a mutual fund and not getting all the other services, it might be time to question that.
Yeah. What are you paying for? What are you
What
getting?
are you paying for?
Yeah.
Are you getting the financial plan? Are you getting the accountability partner? Are you getting a teacher, someone who's going to educate you on the different options, what type of accounts you should be opening, the different tax strategies? Like all of those things that you've just described to us is what the average investor should be getting for the fees that they're paying.
Yeah, for sure. Yeah, it's transparency. And don't ever feel bad about asking your advisor for their full fee, your all-included fee. What are you paying?
Is there anything I should have asked you that I haven't yet asked you when it comes to the value an advisor brings?
Well, I think one of the big things and one of the big deterrents on your returns often is a client's emotions get in the way, right? Reacting to what we see in the news, and there's no shortage of what's in the news these days. But to panic, because of something and make a hasty decision. I actually read the other day, there's a study that came out that said panic selling reduces the returns of that client's portfolio between 4 and 5% compared to somebody who doesn't panic.
Wow.
So, that's a big job for an advisor to keep people focused on the long-term goals, to not, panic when things seem like there's always going to be something in the news.
Yes, and making sure that the type of portfolio you're in the first place is suitable. So if you were working with a client that you knew was going to panic and do the wrong thing, would that change what you would recommend they invest in?
Well, it's all based on what their risk tolerance is, right? And to remind them of that. And, especially if a client's withdrawing money and they need a certain amount within the next 2 to 3 years, best to keep that portion not invested so that you can ride if things get volatile, you don't have to sell when things are down. Right? That comes back into the whole planning. The big picture.
We know this. It's obvious that to make money, you buy low and sell high. But the human emotions are a powerful thing. People get scared. This time it's different. The sky is falling. We've never gone through this before. I mean, every single year, as far back as I can remember, and way even beyond that, there was always a negative headline.
Yeah, it sells.
Yeah, so if people can be calm, the reverse is also true.
Oh, everybody wants gold, right? It's the hot thing. Everybody wants to get on the hot trend.
And maybe it's crypto, and maybe it's technology, and maybe it's gold, or maybe it's oil, or whatever it is at any particular moment in time when things have already had a run up and it's really high. So what is a good advisor going to do in that case?
If they're wanting to jump in at the top? Well, I mean, first of all, you want to listen to the client, right?
Yeah.
You don't want to dismiss them. But I think you have to bring it back to what their long-term goals are, right? You know, I would say, you know, if they're adamant about having it, a little bit maybe is a test to see how it feels. But I wouldn't say, okay, go sell your portfolio and let's jump into gold at this point.
Make sure you've got a diversified portfolio.
A diversified portfolio, yeah.
That's going to meet your goals, is suitable for your risk tolerance, your risk profile, and is going to be there and do the things you need it to do over your lifetime.
Yep.
So is there a free consultation available? Can people meet and get a second opinion and not pay?
Yeah, absolutely.
And do you recommend that?
Yeah, why not? I mean, find somebody, find somebody that you feel like you have a connection with. And if you're not getting that now, go and meet other people. Anybody's going to say, come in and talk to me or have a phone call with me. Let's have a second opinion of what your goals and your needs are and what you're invested in. You know, an advisor can also look at your statement and have a pretty good idea of what you're paying in fees too.
Right. So ask those questions. And be enlightened. You can always take that information back to your current advisor and re-ask your current advisor to step it up. And maybe that works out well. And if not, only you have control over your situation.
Yes.
So make sure you choose your advisor wisely.
And it's not that difficult to change advisors. I think some people think it's a big, it's going to take a long time. It's not a hard process to do.
Jill, thank you so much. This has been really informative. It's given our audience lots to think about. Appreciate it.
Thanks for having me.
And we really appreciate our audience. Thank you for your likes, your tweets, your comments. What do you want us to cover next time? Let us know at thewealthylife.com. As always, please seek independent professional advice before taking action. We are here to provide information to help you learn and ask the right questions to make smart decisions so you can live the wealthy life.